spend. Well, what happens if GDP falls out of bed? What happens if some of these calls that I have today of the firms that I read to you that are taking down or their growth estimates or raising their probabilities of recession? Do you think that those tens of billions of dollars that investors have counted on these companies spending are going to still be spent? I heard Nadella saying not so fast.
Microsoft makes software that goes into employment. So if you're seeing fewer people get hired, you need fewer licenses for Microsoft Office. If you have Meta is 98% advertising. Advertising is a cyclical business. Same thing with Google. Amazon, it's a consumer business. Apple, consumer business. Tesla, consumer business. This notion that these Mag 7 names are not cyclical and not sensitive to the U.S. economy is absolutely preposterous. Are they higher quality? Do they have better free cash flow margins? 100% yes, but we all still do breathe the same economic air.
It's true, right? As bullish as you might be relative to the declines, I think that's a perfect way of framing it.
So not to make this the Microsoft party, but I was listening to the earnings call last quarter and heard Amy Hood say something to the effect of, we've got about $300 billion in contracts that we can't even put on our books as receivables because we don't know when we're going to be able to build the capacity to meet that demand. That, to me, is a bullish signal that regardless of what is happening in the near term with a trade war, Microsoft is going to be fine. And I keep using them as my example, but I'm realistically talking about all of the big tech names that don't rely on the consumer, right? So Microsoft is not directly tied to the consumer. NVIDIA is not directly tied to the consumer. Anybody else like an Apple who has to rely on China and other parts of Asia, I understand the concern. But here, we're talking about software companies that aren't tied to the consumer, and they're going to continue to make those investments because they can clearly see where that's going to pay off.
Yeah, I mean, we talked software. I ran through NVIDIA. Obviously, if you look at some of the other chip names, you could almost throw any one of them up. Broadcom, Micron, Taiwan Semi, AMD. The charts pretty much look like that. Christina Partsinevelos, as you know, follows this space so closely and has been watching all of this transpire. Just tell us some more about what you see.
Well, you mentioned all the bloodbath, but these chip stocks really continue to fall just over the past 2 days, despite the initial exclusion from Wednesday's broader tariff announcement. Just yesterday, this according to the Wall Street Journal, President Trump revealed aboard Air Force One that chip stocks, that are chip tariffs, are actually coming, and that's really what put the sector into free fall. So, like you mentioned, NVIDIA down 14% since Wednesday's close. That's wiping out nearly $400 billion in market cap. That's like wiping out an entire Netflix or Oracle. The impact could be particularly severe for companies heavily dependent on China, given the escalation. Intel, Applied Materials, Qualcomm each derive at least 30% of their revenues from China, and they're down between, look at that on your screen, 5 to 11%. The SMH, which is a good barometer for chips, it's an ETF, has dropped over 15% in almost 2 days, and that's outpacing the broader market, the S&P 500. We'll show you that just the two against each other in a second, and it's during the same period. So chips are definitely facing a lot of pain, even a double whammy, as I like to say, because you have these looming new tariffs that President Trump has alluded to, and then you also have existing AI diffusion export controls that should come into effect in mid-May, restricting the sale of advanced AI hardware to certain countries. They're separated into tiers. And some analysts really warn these policies could accelerate China's development of domestic alternatives to U.S. chip technology, creating this long-term competitive challenges specifically for American firms. So you're getting the tariffs, and then you have the AI diffusion rules that we need to keep in mind coming soon.
All right, Christina, thanks for that, helping us understand all of that a little bit better today, too. You bought NVIDIA at the open today.
I did.
Bought more of it. So you feel like that's enough is enough, and even if you don't catch the exact right moment, it's still okay?
Well, I'm not necessarily bullish on the entire chips sector, right? So I'm not buying NVIDIA necessarily because I'm bullish on the AI revolution, which I am. I'm actually looking past it because eventually inference in the data center is going to pass us. It's going to move to mobile. It's going to move to the cloud. And I think that we have to consider the fact that NVIDIA is going to play a really big part in autonomous driving when it comes, and specifically I'm talking about autonomous trucking. And so for me, this is an investment in Jensen Huang's ability to find the next parade and get out in front of it. And I think that NVIDIA is going to participate in that expansion of autonomous because we have no choice right now. We're down something like 1 million or so truck drivers, and they're not being replaced by younger people anytime soon. And so I think that the only solution is going to be a tech solution, and NVIDIA, to me, is probably the better way to play that space.
I would say the other, big story today, aside from talking about a potential Trump put or when is enough, at least in the White House's mind, is how the Fed's thinking about all this. The other half of that, or the other side of that coin, too, is a alleged Fed put. Does one exist? Appears lower than this, though. Certainly, if you listen to the Fed chair today. Let's bring in our senior economics reporter, Steve Leisman, with more on that. That's the big takeaway, right? He's content with just waiting and seeing.
If you might, Scott, I'm not sure how content the Fed chair is to see the market come off like this. And I know that's not what you meant, but I just want to be clear here. I'm pretty sure he's not content about that. Look what he did. He acknowledged publicly what markets have figured out, and they're selling off on. The effects of these tariffs on the economy and inflation are going to be larger than anybody expected, larger than he expected. And he may have, as you suggest, Scott, disappointed markets in saying the Fed is in no hurry to change its policy and is going to make sure temporary tariff inflation doesn't turn into permanent inflation.
Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem.
Now, he did go on to say the economy is in good shape, that policy is still moderately restrictive, and tariff inflation could be temporary or more persistent. Here's how the market is pricing the Fed. 34% probability of a cut in May. It had been higher before Powell spoke, up near 50, but there's still, call it 4 cuts built in. There had been 5 cuts built in. So the market does think the Fed comes to the, rescue here eventually, and that might be the key. The question here, whether the economic effects of this market downdraft become serious enough to become another economic factor that motivates the Fed to act, they'd have to assess it very seriously to overcome their concern, Scott, about tariff inflation.
Let me ask you a question real quick, because I feel like it's one that's being discussed and still debated. The difference between the market and the real economy, and the wealth effect being taken down by such dramatic levels, at least this week, and overall, if you look at the decline in the stock market from the most recent highs, and whether there's a closer relationship than ever between that wealth effect and the real economy, and if that's something that they would be more concerned about as a result.
I think that is something they're concerned about. For sure, the idea that there is a wealth effect, it's, 5 cents on the dollar, depends upon, what measurement you use. There's also a sentiment effect. There's also an effect, Scott, through the cost of capital. You saw a couple IPOs withdrawn today. What does that mean? It means companies that were going to raise capital to put to work to invest in the economy, hire workers. That ain't happening right now. So that's another economic factor that comes through. And Scott, if I might, I was fascinated by your panel. I'm thinking about how this market is trading, and I believe it reminds me of another time when the market traded with a certain opacity. And I was listening to Claudia there earlier, and the idea of where are the losses from these tariffs? I don't know that the market knows where they are. And you can think about a bunch of indirect and direct effects. Some companies will be hit directly by the tariffs. Other companies sell to those companies. Some companies are going to be hit with retaliatory tariffs. And I was fascinated by the discussion, which I think everybody has to do right now, which is to step back and say, is this indiscriminate selling as a result of opacity because we don't know where the losses are? And is there a way for me to look in and figure out this company is immune, this company is going to lose, and this company is going to win? It's very hard to do that right now, especially because there's a broader overlay here of what is the macro effect on all of the companies if there is indeed a recession. We talked to Bruce Kasman from JP Morgan earlier. You talked about his recession call. Also says that if you do get into a recession, corporate earnings could be marked down by 20 to 25%. I don't know that the market is there yet, and I'm not saying the market ought to be there.
Steve, thank you very much. That's our senior economics correspondent, Steve Leisman, on all things Fed and the economy for us today. I appreciate that. Cameron, I will go back to you. I just want to ask you, do you think it was a couple weeks ago, we had this moment of, maybe it was a few weeks prior to that, as momentum was rolling over, there was a significant amount of deleveraging going on from the hedge fund community, multi-strats, and whoever, that were just caught on the wrong side of where we were. Do you feel like that process is fully over from, long-only hedge funds that may still be out of position a little bit, some of those larger firms that run a bunch of different kinds of strategies? How are you thinking about that issue, and how should we be?
Yeah, when we talked a few weeks ago, what we noted was that the Deutsche Bank Consolidated Positioning Indicator had fallen from the 98th percentile to start the year, and it was in the mid-20s, to say you'd taken a lot of length out of this market. But what's interesting is that in that slight rebound we had in late March, you saw a lot of length get put back in. The other interesting thing is that despite the fact that you saw a plunge in AAII sentiment, you did not see that plunge in the equity allocations. So equity allocations were still a couple percentage point from all-time highs or multi-decade highs. So people said that they were bearish, but they weren't quite selling yet. I have a feeling when we run those numbers over the weekend and rerun them today that they'll look a lot more bearish. You'll see positioning be closer to the single-digit percentile, and we'll look for those flush indicators as well to see what Steve was talking about, that indiscriminate selling. That's why we look at things like percentage of names at 20-day lows, because it gets you to the point where people are throwing the baby out with the bathwater, and that usually is a sign when correlations go to 1, that's a sign that a lot of the selling pressure is at least close to being over in the short term.
It often happens, too, with capitulation by the retail investor. But the data that I saw today from JP Morgan suggests just the opposite, that yesterday, through the declines that we witnessed, that retail was buying, and buying a lot, because they, like so many of you and others who are watching this program, said maybe enough is enough, and I'm a longer-term enough investor where maybe this is a good enough opportunity.
Yes, and just before we started the conversation, I actually heard that today there's actually been dramatic retail selling. So that just reversed. Reversed in the past day. So I think that's a very interesting dynamic. Of course, you don't know how much further there is to go, but they were excited to buy on the dip yesterday, and today they're scared and really starting to sell. So I don't know how much further there would be to go, but retail is starting to get a little nervous.
Okay, a lot of people are. A lot of people are. And on that note, just to wrap this up, I'll just read you what Lloyd Blankfein posted on social media earlier today in terms of people getting nervous, in terms of real people out there getting nervous, retail and otherwise. Quote, the switchboard at the White House must be burning up with governments trying to surrender in this trade war. Why not give them a chance? Make the 10% minimum tariff immediate, but defer the quote-unquote reciprocal part 6 months. Take the win. The president said he'd make us tired of winning. I'm there now. I presume there are a lot of people out there who may feel the same, watching their retirement accounts get just hammered over the last couple of days, and certainly this week. Everybody, thanks so much for being here. Avery, Malcolm, and Cameron, we'll see all of you soon. We are getting some news regarding TikTok, some more. There's been a lot this week. Eamon Javers, what do you know?
Scott, we have a statement now from ByteDance, and this is potentially significant. Here's what ByteDance has to say about this ongoing conversation. They say ByteDance has been in discussion with the U.S. government regarding a potential solution for TikTok U.S. An agreement has not been executed. There are key matters to be resolved. Any agreement will be subject to approval under Chinese law. So a couple of thoughts there, Scott. One is potentially significant here that ByteDance is confirming that there are conversations going on here with the U.S. government and ByteDance. That's new as of today. They're also talking about a potential solution here. They're not using the word sale of TikTok U.S., so that's something to look at. Maybe bringing on more investors, more dilution, that sort of thing. We don't know what exactly that means. And also the last line of this statement here, Scott, I would flag for you. Any agreement will be subject to approval under Chinese law. That brings into play Xi Jinping, the Chinese leader, who will have a say here. And the question around the TikTok sale has been and remains, does Xi Jinping want to sell this, or does he feel that he's being bullied into a sale by Donald Trump? And will those interpersonal and geopolitical dynamics get in the way of a transaction here? Or is there some way the President of the United States can leverage these new tariffs in order to cut a deal with the Chinese government? All that's still TBD, but we do now have a confirmation that there are some discussions at least going on right now, Scott.
I think those are the most important points to consider, too, is what ultimately does China decide to do, and how, if any way, does this play into this new dynamic trade war, right? That's a real interesting card that could be played on both sides.
Right. The question is, how much does China value having TikTok versus this ongoing escalation of a trade war? Do they value having TikTok more than, say, a lever to de-escalate in the trade war and give President Trump some kind of a win here so that the president then has a path to de-escalation? Maybe they do, or maybe they value TikTok and they don't want to be pushed into a deal that they feel is unfavorable to them. And they say, we're going to hold it and we're going to make the president eat the political pain of being the American president who shuts down TikTok and, reaps the wrath of the millions of TikTok users in the United States. It's very hard to suss out exactly where this one's going to land, Scott.
Yeah, no shortage of potential buyers, as we've learned over the last 72 hours or so. Eamon, thanks for the update.
You bet.
Eamon Javers in Washington. Multiple companies reportedly delaying their IPOs now, including Chime and eToro. Leslie Picker is here with the very latest. Easy to see why.
Yes, very easy to see why, Scott. And for a minute there in 2025, it seemed like we had a few dogged IPO candidates willing to brave the policy uncertainty and tap the public markets. But the last few days have really slammed that window shut, at least temporarily. I'm told Klarna and StubHub were set to launch their roadshows to market their deals to investors just next week. But of course, this massive sell-off and spike in volatility are huge headwinds for these companies to maximize pricing, and prospective investors are very much tied up in managing their own portfolios with little appetite to take roadshow meetings right now. Put together, this is either a speed bump or a red light on the road toward this capital markets revival that we've been hearing about. In the first quarter, U.S. IPOs were actually up by 43% in terms of combined offering size and 74% in terms of the number of listings, but M&A activity still pretty dormant, meaning investment banking revenue overall is expected to have declined in Q1 as bank earnings kick off a week from today. And that's just a piece of the banking story. Take a look at some of the recent performance. JP Morgan, Bank of America, Citigroup, sizable declines here, declines yesterday, as well as concerns that the trade war makes a recession more likely. Analysts say that even though banks are not directly impacted by tariffs, they could put a cloud over much of their client base, which can thwart loan growth and deal making and wealth management. And potentially later in the year, we could see some issues with credit quality. Scott.
All right, Leslie, thank you very much for that. That's Leslie Picker. Now let's bring in Chris Toomey of Morgan Stanley Private Wealth Management. What are you telling your clients? Thank you for being here, by the way.
Thanks for having me.
What are you telling them?
We're telling them this is why we've been so defensive. I think in our mind, we were really concerned about a lot of different issues that we think were going to push that PE multiple down. We saw this affect P, and we think we've seen kind of the first phase of this, right? We saw a situation where prices have come down. What's interesting is you're starting to see that kind of first level of group that would be affected by tariffs, and they've come down. Now we're really getting into that second level with regards to the knock-on effects of this. We've seen GDP growth starting to come down, inflation numbers picking up, consumer confidence coming down, CapEx is coming down. We're starting to enter into that earnings period. We're now concerned about that E part of the PE.
What do you do when they say, but yeah, Chris, Trump likes the stock market. He's not going to tolerate this for that much longer. And oh, by the way, the Fed, I've always believed in the Fed put. It's worked for me every time. Why is it going to work now?
I don't necessarily think the Fed put is going to be on the table for a little while. I think our concern is a lot of these actions are inflationary. And I think if you saw Powell's comments and you guys were just talking about that, I think he's still on hold. I think he's concerned with regards to what these actions are going to do with regards to inflation. A lot of the responses that companies can do in regards to dealing with these tariffs are going to increase prices, whether it's increasing prices to the underlying consumer or increasing prices with regards to how they manufacture these goods. And this idea of bringing manufacturing to the U.S. is great, but it's going to take time and it's very costly.
What if I said, well, I can make the argument that it's deflationary? You're hurting demand. You're crushing the psyche of the American consumer, the American CEO, and the American investor, rates are going down at a fairly rapid clip. Why isn't this going to end up being the other way?
Because you're not going to see that economic activity pick up. You're not going to be in a situation where people are going to be wanting to buy goods. They're going to be wanting to hold on to things. So activity is going to come down. GDP is going to come down. Prices have to stay higher just because it costs more to produce them. Whether it's labor costs, whether it's actual costs of actually manufacturing them, all of those costs are going to stay higher, and it's going to reduce the ability for us to actually...
Okay, so you're talking about stagflation.
That's our concern. So if you're in a situation where we're going into a recession and the chairman of the Federal Reserve is saying, I'm not necessarily jumping in here and cutting rates.
Well, not today.
Yeah, but what's going to happen in the market for the next couple of weeks, in our mind, I think that still needs to be priced into the market. I still think you're in a situation where you now start having to move up the probability of recession.
People are.
And you're going to start to have to take those earnings expectations down.
People have.
And so if you're looking at that and you're saying, okay, if my earnings expectation is, let's say, going from 280 to 250, and I'm going to put 18 on that, you're talking about kind of a 4,700 on the S&P 500.
Okay, I read through a bunch of different scenarios like that. As you know, I use the Goldman number because that's, a lot of people use that number. From 280 to 269. You don't even believe the 269. You think earnings need expectations for next year are that dramatically high? Because from 269 to from 280 to 250 is a big come down there.
Yeah, so if you're at 280 and you come down to 250 and you apply an 18 times on that, and if you look at 26 and you move that back up to 280, you apply 20, that 4,700 becomes an interesting area, and that's also an area from a technical standpoint where the 200 week is basically going to be. So in our mind, yeah, you're looking at some opportunities right now where stocks have sold off that are down 20, in some cases 30, 40, 50%, that are starting to look very attractive. But we're also starting to see those knock-on effects. You're talking about Mag 7. Mm-hmm. Yeah, these stocks are down dramatically, but what do you think is going to happen over the weekend? Where do you think Europe is going to come back like China did with regards to their tariffs? They're going to focus in on those Mag 7 companies, right? And those Mag 7 companies, where the S&P 500, 40% of the revenues come from overseas, the Mag 7, it's over 50%. So you could see downward pressure just because there's such a huge part of the market.
Okay, another client calls you and says, yeah, I hear you. It feels like garbage out there. But Chris, what about tax cuts and the deregulation?
Yeah.
We know that's coming. What about that?
Well, the question is can we get there, right? I think we're in a situation right now where we used a lot of political capital with regards to these tariffs. The question is how well are we going to be able to get there if you've got a lot of congressmen in districts that have a lot of angry constituents with regards to the tariffs, and say, before we start talking about tax cuts for the rich, let's start focusing in on jobs and getting these things going, because you're going to start to see companies in these earnings reports talk about hiring and talking about future projects, and there's going to be a lot more uncertainty about that, just like they are in the market right now.
Yeah, but I mean, the alternative is telling your constituents that, well, we're not renewing the tax cuts, so your tax rates are going to go up as you're already dealing with the ramifications of the tariffs. That doesn't sound very tenable in my mind.
No, I think we're in a situation where that was what everybody was expecting, right? And we talked about sequencing. What's going to come first? Is it going to be the tax cuts? Is it going to be the deregulation, M&A activity, all of these other things? But you're in a situation right now where consumer confidence has come down so much. Like, unless we deal with the tariffs, I don't know how you focus in on these tax cuts.
Well, you expected the tax cuts and the other stuff to happen sooner, to happen first?
I expected them to be doing not necessarily as much as they were doing with regards to these tariffs. I think I think the market's expectation was that they were going to be a lot more thoughtful and strategic with regards to how they were going to implement these things.
But they put out a bunch of Greek symbols, Chris.
Greek symbols?
Yeah, to justify whatever their numbers were and wherever they, wherever they pulled them from.
Okay, I must have missed that. But I think the fact of the matter is you can look at the activity in the market, and the market didn't expect this. Otherwise,
there's no question about that. There's no question about that. But to some degree, nor does the market necessarily expect that they are going to remain at these levels in terms of the tariffs. I don't necessarily think the tariffs are ever going away, but the notion that you're going to stay at the highest of the high levels, you believe that?
So let's take a step back. Let's look at one of the greatest bull markets of history, driven by two main factors: the increase in globalization and the advances with regards to technology. If we're taking that idea around economies of scale within globalization.
Forgot one thing, but I'll let you finish.
We're talking about demographics?
No, I'm talking about the tremendous injection of liquidity into the markets by the Federal Reserve.
Right, which is becoming another problem, right? Because we're looking at the Treasury issuance in 2026, which is why people think rates have to come down. But the fact of the matter is that you take that away, right? You have to start thinking, what are my return expectations for equities and risk assets in this environment? It's not necessarily a relative game between U.S., Europe, and Asia. This is really a situation where you have to start ratcheting that down if we don't have those economies of scale.
Let me ask you lastly before I let you go. I'm reasonably certain that the advisors at Morgan Stanley Private Wealth on Inauguration Day, certainly on election night, and Inauguration Day did not expect this, did not expect this. And many were telling their clients, because they were believing it themselves, that this is going to be good for the markets because Donald Trump cares about the markets and the economy. They're going to put their arms around business in a way that other administrations allegedly have not. You're going to have a much more robust deal-making environment. How much have you had to reset your own expectations from what you thought to what you have?
I think this is a key point. When you're looking at a client situation, you have to understand these are things that could happen. And so sizing that equity exposure, sizing that risk in a client's portfolio is critically important so that in situations like this, when the market sells off, these are opportunities that you can take advantage of, right? And so if you are overextended with regards to Mag 7 and you're not diversified, you're not going to be able to take advantage of it. So no one knows what's going to happen as much as you get smart guys on the show. But the fact of the matter is you have to look at the probabilities and protect that capital because it's so painful when you lose it like these markets.
Thanks for being here on a really big market time for all of us. Thank you. Chris Toomey, Morgan Stanley Private Wealth, as we said. To Contessa Brewer now for a check on how travel and leisure is faring not well. We know that.
That's an understatement. Yeah, but I think what you're seeing here, Scott, really is recession worries, the consumer concerns about how much stuff is going to cost with the new tariffs and whether that's going to eat into the family travel budget. And we're watching cruise stocks sinking here. Viking, Royal Caribbean, Norwegian, Carnival. As you can see, they're all down on the day. Viking the worst on the day, but week to date, now you're seeing Carnival and Norwegian and Royal Caribbean as much as off by 19% this week. Hotels, Marriott, Hilton, Hyatt, Wyndham lost about 4% today, as much as 10% this week. Travel platforms, Booking Holdings, Expedia, TripAdvisor really taking it on the nose. And gambling, well, investors are just walking away from the risk here. Las Vegas Sands, one of the laggards in consumer discretionary today, Wynn and MGM. Look, they could be facing some major anti-U.S. sentiment in Macau just when they're still trying to get back up to pre-pandemic levels. They've lost between 12% and 16% this week. And then you've got Caesars, Penn, DraftKings, the game makers, Light & Wonder, Sphere Entertainment. Everybody's loving these shows at the Sphere, but it is down in a big way because of the worries about whether people will go and spend big on those tickets, Scott.
Yeah, wealth effect, the old wealth effect. We keep talking about that. Contessa, thank you. It's Contessa Brewer here, as you see at the New York Stock Exchange. Now let's get to Ryan Dietrich, Carson Group's chief market strategist, for how he is navigating this sell-off. You've been unwaveringly bullish, man. A lot. I'd say every time we've spoken, maybe you've changed it on other programs. I haven't seen you. Are you still?
Yeah, thanks for having me back, and happy Friday, everyone. You know, Scott, I know I was only actually in the middle of February this year. I on air said maybe we get a banana peel weakness because we were stretched. Did we expect this? No. Obviously, like a lot of your guests have come on, probably did not expect the 17% as of now correction, obviously down 13% on the year in the S&P 500. You know, we're still optimistic, yes. You know, you think about it just today. I mean, I look at credit markets. I mean, high yield bonds are down like 1% today. They're down about 2% on the year. Now, we understand what's happening out there with people's investments, retirements, all the worry and uncertainty. When you see that, that's positive. You know, cryptocurrencies are higher today, too. I mean, there's not a lot of positives. I get it. But the flush out, the last comment here, I mean, the VIX is around 45, right? Look back in history when the VIX hits 45. I think I was on with you back in August of last year when the VIX hit about 45, and we talked about it then. That can be that sign of capitulation. We haven't seen spikes in put-to-call ratios. We haven't seen a VIX spike. We've clearly seen that the last 2 days. So there's some minor positives clearly in a sea of negativity.
How much worse do you feel like it can get? You know, you've had some people throw out 1987, similar trading patterns that have taken place on a Thursday, Friday, and then a Monday that nobody who lived through that period will obviously ever forget. Obviously, the president can change a lot of things over the weekend. We just don't know. But how much worse do you feel like it can get or needs to get?
Yeah, I don't think it needs to get much worse. I mean, we're close. We're at washout levels. We've seen, I don't know what the exact numbers will be today, but yesterday, like 93% of all volume was lower on the NYSE. I mean, that's historic stuff. You mentioned 87. You know, we're looking at back-to-back days on the S&P down 4%, but down 10% in 2 days, okay? You got 87 in there, 2008 in there, 2020, and 1940, and maybe these last 2 days. So that kind of tells you how bad things have been here. But at the same time, one of the things we've been preaching to our Carson advisors is why you want to be diversified. And I know it sounds kind of boring to say this, but the treasuries are up 6% this year, right? Gold, as we know, is up 12%. Most global markets are higher. I know they're down a lot today. We've liked the U.S., yes, but we have said preaching to stay diversified this year versus last couple of years where we're all in U.S. And I know I came on for a while also saying we didn't like tech, more neutral tech at best. And now we kind of see why that is. You know, low volatility is still up on the year. I mean, low volatility is an area we have liked. There are some pockets out there that have held up well. We still think low volatility, some treasuries, some gold. And honestly, listen, what's the old saying, right? Stock market's the only place things go on sale and everyone runs out of the store screaming. I mean, there are some really good sales. Doesn't mean we're at the lows, but when we look back in 6 months with the VIX at 45, we really do think it's probably going to be an opportunity for investors out there.
Let me ask you this. Everybody says, well, be diversified. Diversification is the key. I mean, it's easy to say. It's harder to describe. What does that mean? 60-40 is diversified or whatever the breakdown is. Am I supposed to be like underweight U.S. stocks through this period and have a much higher weighting to either bonds, cash, or whatever else?
Well, like 60-40 is considered the Bible for diversified. I can tell our tactical models, we're close to about 74% equities here. So the rest is that other part. We've got about 4% gold. We've got some treasuries in there. We actually have some managed futures, right? Because we don't think inflation is going to be a problem. And you've had some great discussions about inflation with guests today. We still don't think inflation will be a problem. But if it is, those managed futures will help you. And in that bucket of about 75%, we've got about 20% international, very little EM, and the rest is U.S. I mean, we still think the U.S. is going to do okay from where we are now. But trust me, being overweight equities the last 2 days has not been fun. But again, those bonds and gold have helped you sleep a little bit at night. And we still are optimistic that, I guess to answer your question where you said how low can we go? I mean, listen, the bear market's only, a couple percent away. I mean, that very well could happen here.
But that doesn't mean that's some phony baloney textbook definition that says, okay, now we're down in a bear market. I could read you, I don't know, 200 stocks out of the S&P 500 that have been in a bear market and are now deeper into a bear market. So a lot of the market has already gone there, which is part of the point about why the destruction has been so dramatic, because so many stocks have already been in that range. I have so many of them on my screen right now. This is a bear market for the most part.
No, you're right. And again, a lot of that is obviously Mag 7, communication services, consumer discretionary. We get it. There were some other groups that were up on the year until the last 2 days. But again, that's kind of where, again, I know, like you said, preaching the same thing here, but from that diversified point of view, if you have some bonds in some areas, it's not quite as bad. I mean, 22, let's be honest, 22 stocks down 25%. Bonds had their worst year in history. At least bonds are acting like bonds, getting that diversification. We say diversify your diversifiers. Bonds and gold are acting like that. Although gold down today because everybody's got to sell some of the winners, but it's still not down as much as the overall market. One other thing, small cap and mid caps, I know they've been just annihilated. They are doing a little bit better today. You got cryptocurrencies up today. So there are some little clues out there, as bad as this has been, that, maybe there's some type of positive in the sea of negativity. A little bit better.
I mean, the Russell's down 4% today. It's down 10% on the week.
Right. No, you're right. I'm just talking about today. And one more thing on this. If you look at intraday, we're getting real cute here. But if you look at intraday on high yield bonds, they made their low earlier this morning, right? Stocks broke their lows in this afternoon. High yield bonds have not. So again, I really like to follow those high yield bonds, and they all in all are truly, I think, hanging in there way back. I mean, high yield bonds are down 2.5% on the year, right? Stock market, we know what it's doing, down 13. And like you said, a lot of other stuff in bear markets are down 20. That's surprising to me. And maybe that's one bit of potential good news that the credit markets are not totally freaking out right now. That says this will spiral into a 35% potential bear market. Maybe we can, bottom sooner, much sooner than that, in our opinion.
Yeah. I mean, you have the prospects, judging by where the market's moving with less than 10 minutes to go, that you could get an ugly or even so close. Ryan, thanks. I'm going to let you run. Thanks for being here, Ryan Dietrich, joining us. Let's get back now to Christina Partsinevelos for a look at the key stocks that she's watching. Which ones now?
Unfortunately, manufacturing stocks, they're hit hard today. Of course, you got the sweeping tariffs. Farm and equipment manufacturers like Deere, CNH tumbling. You can see on your screen, Deere almost 4%, CNH Industrial down 5%, AG Co. or AGH Co. falling about 5 and 2. So just a sea of red. President Trump had vowed to reprioritize U.S. manufacturing, but UBS analysts say the trade dynamics pose headwinds for the agricultural sector. So you're seeing those all down. But I have some positive, another green. GameStop bucking the trend today, higher over, look at that, 11%. And that's because CEO Ryan Cohen increased his stake in the retailer. Cohen purchasing 500,000 shares on Thursday at a little over $21 a share. You can see shares are about $23.50, and this according to a regulatory filing. This brings his stake to about 8.4% of shares outstanding. So it's a vote of confidence in GameStop. Shares up 11%. Scott?
All right. Thank you, Christina Partsinevelos. Kate Rooney's taking a look at Amazon. Did I see something earlier that Amazon's been down for like 7 straight weeks? Is that right?
It's 9. It's going for 9, Scott. So Amazon right now on pace for its worst week. If you go back to November 2022, and it's the longest weekly losing streak since 2008. So tariffs, bottom line, are going to make things more expensive on the e-commerce side of the business, on that marketplace. About 60% of sales do come through third parties, and then about a third of that is going to be coming from China. So these tariffs are very much global, though. It's not just China. Amazon products are coming from all over. You got India, Vietnam, and Mexico. And the White House this week did scrap a tariff exemption that had boosted Amazon's rivals, Temu and Shein. It was this exemption for packages worth less than $800. It was seen as sort of a silver lining, but Amazon has also been using that loophole as well, and has a similar discount service it launched back in the fall. Amazon's cloud business, AWS, it's not helping offset any of these tariff fears. Tech, of course, down broadly today, and then the ad business could be hit by the economic turmoil we may see. Still, Amazon is one of the most bought stocks among retail investors. It's at least according to Vanda Research. They're seeing record dip buying from individuals, Scott.
All right. Kate, thank you. That's Kate Rooney out on the West Coast for us. We're in the market. So now CNBC senior markets commentator Mike Santoli is with us now to break down these last moments of the trading day, ones in which we are moving even lower. Yeah. We're at the lows of the day across the board. Dow's down 2,100 points plus. Talk to me.
Yeah, I mean, these cascading declines, obviously, they are just treacherous themselves, and they don't really obey rules in terms of what levels matter. The market has attempted to make the August low matter all day, and it's buckled a few times. It's like 51.10 or something like that. So we're below that. Now, what you're actually looking for is just wipe out levels of indiscriminate, price-insensitive liquidation. You see some of that today. Finally, record put buying. You have 93% of all volume to the downside. I agree with Ryan in terms of a lot of the safe haven stuff is finally getting whacked. There is no place to hide. Berkshire Hathaway's down. All of the sub-Mag 7 names like Visa and Eli Lilly, where everybody wanted to take shelter, they're finally succumbing a little bit here. And the fact that you have had a little bit of the stuff that was hit the first that's outperforming today, like the Russell, and things like that. Okay, fine. That all lines up to say we maybe have done enough. The problem is you didn't build any kind of fundamental cushion in here, and that's what we're going to have to contend with. We are at a point where, in terms of the technical condition and how stretched we are, you could have a 10% rally over 3 days. And that's the kind of snapback rallies you get from these levels, and still it would be kind of dead cat bounce on the chart. It would just go up to the market's 20-day average or whatever it is. So call it what you will. It's not necessarily a downtrending market yet, but we're close enough that the rules are flipping. perhaps potentially, if it continues like this a little while, into sell rallies.
So, something significant out of the White House over the weekend. How are we setting up potentially for Monday? I ask you the question. You've seen a lot of markets. Jim Cramer talked this morning on Squawk on the Street about 1987. I've gotten texts over the last few moments from some very big market people saying this looks eerily similar to trading on Thursday, Friday, ahead of that Monday. What can you tell us as you're thinking about big picture the markets from the prism of all of these that you've seen?
As a general matter, Friday, Monday dynamics are, there used to be this adage that markets don't bottom on Fridays. And that crashes happen from oversold levels. They don't happen in overbought markets. Now, that's just your general tendencies over the decades of when bad stuff happens. And that Mondays, if nothing else, often you kind of have to test what happened on Friday and you have to see if there was anything real there. All that being said, that's the exception, not the rule. I mean, we usually don't, have these accelerating, crash-like declines when we get a deeply oversold market. So I think you have to keep multiple things in your mind at the same time, which is don't ever expect to, if things start to look tactically more favorable because a lot of bad news is priced in and because nobody's expecting a great headline out of the White House, you can bounce any time, but don't expect that you're going to catch the absolute low in all this stuff. When you do have these crash-like markets, they don't stay at the low for long. You just never know where it is. And so a lot of times you have to have that complete surrender. And I don't know that we're there. I've been pointing this out for a little while. Maybe I haven't emphasized it enough. But the market, in every increment, tried to be really cute about saying, now we can buy it and play for a rally. That was the exact 10% decline in the initial correction. That was the filling of the supposed gap last week. That was, even today, going to the August low. Yesterday it was 5,400, which was the September. So it's understandable that the market wants to say, we're almost there, we're almost there. Almost all day we sat at a 40 VIX. Didn't want to go above until it did.
Jim's point this morning wasn't that this is or will be. It was more like, look, here's what happened then.
Right.
The kind of trading you have and the feeling of the thin ice, my words, not his, that we're on right now, and that the administration needs to figure out a way to get us onto some more stable ground because you can go through thin ice at any moment and you just don't know.
No, that's very true. And again, it's one of those things where you have to be cognizant of the possibility that bad can get worse and worse can get terrible. I just don't know how to necessarily play that when you say, look, the bond market is kind of operating in this orderly fashion. It's calling for the Fed to do something. You could say that what the stock market is doing is acting as equity vigilantes and trying to get the administration to actually just back away, create some off-ramp, have something conciliatory to say, and maybe that is what's happening. And by the way, I think that you have to be aware that there is that upside risk, that this is all optional, what we're doing right here.
That's why
it's just a choice.
Okay, you make a great point, and it's important to always remember, and one that we've suggested throughout this moment of turmoil. The president, the most powerful person on planet Earth, understands that.
Right.
He knows what his words and his policies have done to this market. It can so easily switch.
Right.
It goes to the conversation about whether there is this Trump put or not.
Right.
But that is what still exists and why you could have a reversal at any time.
Which is why it's not comforting in the near term to have the president distribute these things that suggest this was part of the plan, and have administration officials come out and say, oh, actually, it's all this brilliant idea of getting long-term yields down, as if that's somehow going to move the needle on the overall cost of our Treasury debt. But you're right. It is something where it is within somebody's power. You have to be aware that we've already kind of gone from underreacting to what's going on to arguably, in the very short term, overreacting.
All right. Thank you so much for really educating us and helping us understand what might be going on within these markets and where they're going. That's Mike Santoli. Good weekend, everybody. I'll see you on the other side.
Stocks falling off a cliff for a second straight session and closing right about at the lows. All the major averages off 5.5 to 6%, with the Nasdaq closing in bear market territory. S&P 500 wiping out more than $4 trillion in value in 2 days. Crude sinking to 2021 lows, and the 10-year yield dipping below 4%. That is the scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Ford with Morgan Brennan.
We've got you covered all hour with the most important angles of this sell-off that matter to your money, including the latest on the economy and the Fed and how China and other countries are responding to what we saw from President Trump this week. We've got your first move on Monday and how you prepare for it. But let's get straight to the sell-off. Joining us now is Bob Elliott, CEO of Unlimited Funds, and Keith Lerner, the co-chief investment officer at Truist Wealth, along with CNBC's Christina Partsinevelos on the pain for tech we've seen, and Pippa Stevens on the plunge for crude oil and energy, Courtney Reagan on the move for retail stocks, and Diana Olick on one bright spot in the market, which has been the home builders. But first, we go to our market panel. Bob, I'm going to kick this off with you because it has been just a major flush out here for the market. How much further could we go, especially when you look at an S&P that has lost so much value here, 9% this week now, but is still arguably trading at multiples higher than what you'd expect with recession, despite what we're seeing in the bond market with the 10-year Treasury yield falling below 4%.
Yeah, when you scan across the markets right now, obviously the short-term market moves feel extremely large, and they are with any broader context, but the levels matter in terms of where we are in this market. And with PE still at 19 and bond yields still at 4%, none of this pricing looks like pricing in the sort of recession that would come if these tariffs remain in place for an extended period of time. And the reason why that is that basically everybody is betting on the fact that the new administration will roll back these tariffs in short order. If that doesn't happen, it means two things. One, a lot more pain for the U.S. economy and the consumer. And second, escalating retaliatory efforts abroad, kicking off a global trade war. And if that happens, you know, the moves that we've seen so far will look pretty modest in comparison to the wreckage that will come if those tariff policies persist.
Keith, what do you think about this now, especially given the fact that we did have a better than expected jobs report this morning, but investors seem to be looking through that. We had commentary from Fed Chair Powell in the middle of the day that, you know, continues to lean hawkish, and a number of other Fed officials as well. And then, of course, we continue to get these headlines, not only from Washington with the Trump administration and the back and forth with other countries, but also in terms of Congress and lawmakers and the fiscal part of this as things like tax policy begin to take shape, and perhaps maybe not as stimulative based on what we're getting in reports as had been previously expected.
Yeah, well, you just raised a lot of different points and a lot of things that this market is contending with. So our view is this, you know, back in February when we were closer to the highs, we downgraded stocks because there was a lot of complacency, and our work was suggesting there wasn't a lot of bad news priced in ahead of all this event risk. At least on a short-term basis, you know, we're still more neutral in our overall view, but we're telling our clients we would not be selling here today because at least the market is, at least on a short-term basis, starting to price in some of these uncertainties that you just raised. So we're down 17% from an all-time high. The typical recession is down around 24%. So effectively, you're pricing in about a 60% recession probability already. At the same time, you are seeing some things get a bit stretched. You're seeing, as mentioned earlier, put the call ratio spike, the VIX spike. I'm not saying this is the end, and I think we have a long slog ahead of us. But on a short-term basis, you know, I think yes, there's risk of more downside, but you're also at a point where a little bit of good news could go a long way as far as any type of movement on the tariffs at all. Again, longer term, I think this is going to take some time. But again, after two big down days, you know, at least the risk reward is a little bit more favorable than it had been when nothing was being priced into this market.
Yeah, we had a little bit of good news trying to break through today, but got faded each time. I want to talk the nature of this sell-off, Bob. For those tempted to buy the dip, and retail investors have been, as dramatic as the sell-off have been the last couple sessions. I hesitate to call it panic selling. The VIX did spike to, I think, 45 at today's highs, roughly, above the yen carry trade levels of last August. But does this strike you as overdone in the nature of it, or rational based on the facts on the ground?
You know, in the grand scheme of things, the sell-off that we've had, while large in size, has actually been pretty orderly in terms of seeing, broad-based intermarket action working largely as you'd expect. For instance, a good indication is the fact that we're continuing to see bond yields fall in response to equity market weakness. That's a sign that, the market is moving to price in a weaker growth environment rather than creating a broad forced deleveraging. I think the main question in terms of what is holding up the equity market is whether the buy the dip trade and the vol sellers, which have been so prominent in this market for the last couple of years, are they going to start to capitulate? And as you highlighted, data that was out from yesterday suggested some of the biggest buying by retail investors into the sell-off. If those folks evaporate and we have institutional money and hedge fund money that is already scaled back and is hesitant to come in until there's much more value in the market, that risks creating a significant air pocket between where we are today and where we'll get those value-based buyers coming into the market.
Now, Keith, as investors look at their portfolios, kind of survey the damage over the weekend, think about what to do next week. We've talked policy, we've talked macro a bit. I want to go more micro, talk about earnings, because we're going to start to get bank earnings toward the end of next week. As you mentioned, 44 days ago, we were near 6150 in the S&P record highs. We're down about 17% from there. But what happens to guidance from here, and perhaps the calculation on earnings per share for the rest of 2025 based on that? At some point, perhaps even during this earnings season, do we have to start pulling in those estimates? Does that affect valuation calculations?
Absolutely. And that's one of the reasons why we had downgraded equities in February, because we started to see the economy weaken, but forward earning estimates for the market continue to make 52-week highs. So there's a disconnect. And now, as the economy continues to likely cool, those forward estimates need to be cut. Now, I will say the difference now is that we're down 17%. Part of this action right now is that we have uncertainty about the valuation level, but also about the E. So I think right now this market is anticipating that we are going to see some weaker guidance. If you're a CFO of a company or a CEO of, especially a global multinational, I don't think you're going to step up and really have a lot of confidence in what the outlook over the next 12 months are, or even the next 3 months. So I think what's going to be just as important is areas that have been hit already as far as a stock basis. How do they act on the news of the guidance cuts? Because we are going to get some cuts in guidance likely coming up.
All right. Keith, Bob, thank you. Quite a week, rough week for the market.
2,200 point move lower for the Dow today. We've only seen that 3 other times in history. All 3 of those times were during the heart of the pandemic, so back in 2020. This is the 3rd worst from a point drop, a 3rd worst drop for the Dow in its history.
Quite something to see. The NASDAQ closing in on a bear market, down more than 20%. That is bear market territory from its 52-week high. Our Christina Parks-Nevelis is at the NASDAQ market site. We'll look at some of the most shocking declines. Christina?
Where do I begin? Well, the market plunge really accelerated among tech names just this afternoon. I'm going to look specifically at the NASDAQ 100, which really looks at the largest 100 non-financial firms. Lululemon and MicroStrategy. Only those 2 names, MicroStrategy, a big holder of Bitcoin, the only 2 names to close in the green out of 100 names. And ever since tariffs were announced on Wednesday, Mondelez is the only stock on the NASDAQ 100 in the green during the last 2 sessions. And just barely, up maybe 1% over the last 2 days. And half the index, 50 names, down at least 10% or more. NVIDIA, off to talk about it, plunged more than 14% over the last 2 days. And I say that because that's when the tariff news came out, wiping out nearly $400 billion in market cap. That's like wiping out an entire Netflix or Oracle. Amazon seeing its longest weekly losing streak since 2008. Remember those times? Apple down 13% week to date on supply chain disruptions, demand and uncertainty. You can see double digits on your screen for both those names. And since I covered ships, really hit hard post-tariff news. The SMH ETF dropped about 15% in almost 2 days, far outpacing the broader market decline of 10% during the same period. And so traders really now are questioning if this sell-off marks a meaningful shift in market sentiment. I know you just discussed that, or merely a temporary correction, which might not be the case. Guys?
Christina Parts-Naveles, thank you. Also raises questions about what happens to AI CapEx in this environment and the ripple effects there if we continue to see uncertainty. Well, oil prices plummeting today, again, falling to their lowest level in more than 3 years. The energy sector is down 14% in a week. Pippa Stevens has more on the fallout. And Pippa, tariffs are one piece of it, but we've also seen some policy moves from abroad this week as well.
That's right, Morgan. And WTI did drop to $60.45 at the low today. Tariffs and demand concerns are the overarching bearish backdrop here. But as you noted, the surprise announcement from OPEC and its allies to raise output by 411,000 barrels per day come May, effective of production increases, is accelerating that bearish sentiment. Goldman Sachs cutting its oil target, saying the two key downside risks of tariffs and OPEC supply are here, with JP Morgan adding, quote, for oil prices, the trajectory is unmistakably one way. Now, energy stocks are tracking for their worst week in almost 3 years. Drillers, APA, and Diamondback are the biggest losers this week because of exposure to oil prices, while the OIH, which tracks the services names, is down significantly more than the XLE, thanks to fears that a drop in prices will cut drilling and therefore operations for names like SLB, Halliburton, and Baker Hughes. Now, nat gas had been a bright spot thanks to AI power demand expectations, but it couldn't escape the selling, dropping 7% today as we head into the mild shoulder season for demand. John?
All right. Pippa, thank you. Now let's get to Courtney Reagan for a look at the moves for retail stocks. Court.
Hi, John. So the XRT down just over 1% kind of feels like a relief rally, really, after Thursday's rout. I mean, there were a number of positive discretionary retail stocks on the session, some moving higher on the possibility of potential negotiations with Vietnam to lower the newly announced tariffs, or that Southeast Asian countries may also deploy some strategies to ease production pressure for the manufacturers there. Now, Victoria's Secret, as an example, shed 18% of its value on Thursday, but actually finished the day up by about 14%, down about 7.5% only for the week. But actually, after those 2 days, not so bad. Similar action with shares in other apparel names like Abercrombie, Gap, Kohl's. U.S. imports about 19% of its apparel sold here from Vietnam, so just slightly behind Chinese apparel imports. Vietnam is the largest country of import for footwear at 34%. So if those tariffs I mentioned are lowered, that does benefit shoemakers like Nike, On, Skechers, Crocs, and others, which sold off so sharply yesterday to the tune of 20% or more in some cases. But for the week, we should note that Five Below still down about 20%, RH down 38%. It had some disappointing earnings too, so not all a tariff issue there. Capri Holdings, VF Corp, both down 26% for the week. So some relief in some names today, certainly not all. Morgan?
Huge moves within the retail space and consumer space. Courtney Reagan, thank you for breaking it down for us. Let's now get to Diana Olick with a look at the outperformance in home builders as rates have also fallen this week. Diana?
Yeah, that's right, Morgan. Housing stocks rallied today because interest rates, as you said, were falling. The average rate on the 30-year fixed mortgage dropped 8 more basis points this morning to 6.55%, according to Mortgage News Daily. That's down 20 basis points in just 2 days, or since the tariff announcement, and it's the lowest rate since October 4th of last year. Now, the homebuilder stock sold off yesterday, but they rallied back today. The home building ETF ITB, which includes builders and building product stocks, was up. Names like Lennar, Pulte, and even luxury builder Toll Brothers are also up on the day, but consider the impact on the recent drop in rates on a monthly payment versus where we were just at the start of this year when rates were a little over 7%. The difference on that monthly payment is about $125 on a $400,000 home with 20% down. So, you know, when you're paying over $2,000 a month on that mortgage, is $100 really going to make that much of a difference? Apparently the builders thought so today. We'll see going forward. Back to you.
Diana, thanks. Well, now let's turn to senior markets commentator Mike Santoli for a look at whether markets are due for any relief after this week's ugly print.
Yeah.
Mike?
Yeah, it's not a matter of whether we deserve any relief, but whether we're set up for it. I mean, arguably, yes. And I think one way to look at it is just how much downside we've basically endured over a short period of time, and therefore how far back in time we go. And the NASDAQ 100, you guys are mentioning, down 20% off a high. So that's one threshold definition of a bear market. But it happened so quickly that, in fact, the 200-day average, I don't have it here, but it's basically just started to flatten out and go down only over the course of 2 or 3 days. Usually a bear market means, okay, the trend is lower. This really has just gone vertically lower. We're back to levels first seen in January of 2024. So that's like 15 months of upside, more or less undone. And, valuations, have they reset enough? If you take Tesla out of the Mag 7, maybe it looks like they're sort of getting not as expensive, 22 times earnings or something like that. So, it's in this in-between zone. Hard to conclude whether you have any fundamental support coming in, but definitely getting very oversold. And there was a get me out at any price type of vibe today. Take a look at the Russell 2000. I spread this one out to a 10-year chart. Why? At the lows of the day, we were only 2 or 2.5% above there. That's the 2018 high in the small cap Russell 2000. So you see we've sort of shuttled back to the lower end of this multi-year range we've had in there for, since pandemic times. And interestingly, as I mentioned in the last hour, you actually saw Russell 2000 outperform today by like 1 percentage point of the S&P 500. That's often a sign that, some of the hardest hit areas that really were in the lead of this decline are maybe getting some relief. You've moved on to some of what seemed like the safer stuff that was sold. Look, this is all in the life cycle of a nasty correction that we're in.